This is Let's Talk Energy, your go-to podcast for smart energy insights. I'm your host, Noah Brenner, and each week we're bringing you an inside look at the dynamics shaping global energy markets through in-depth conversations with our own Rystad energy experts and some special guests. Now, in today's episode, we're digging into an energy story that's been dominating the headlines: Venezuela. The U.S. capture and extradition of Venezuelan President Nicolás Maduro on January 3rd has been the biggest energy story of the very young year, as we all try to understand the short and the long-term impacts on oil markets. Venezuela's production had peaked at around 3 million barrels per day, but had fallen into steep decline in the ensuing years as corruption and neglect pushed production down to around 1 million barrels per day. And now a U.S. naval blockade has further cut the country's exports. However, the country claims the world's largest oil reserves, though much of it is locked up in heavy crude that's difficult to get to market, requires an immense amount of infrastructure, and both of those make revitalization of the country's oil industry a time-consuming and expensive proposition. So, why does Venezuela have outsized importance in the global oil markets, and how could what looks like long-term U.S. involvement in the country's oil industry impact markets? How much money would it take for Venezuela to return to its lofty historical production, and which companies might be willing to invest? Finally, what are the geopolitical ramifications of the U.S. reasserting its control over the Western Hemisphere in Venezuela for both China and the OPEC Plus producers group? To help us understand the rapidly evolving situation in Venezuela and its impact on the energy industry, I'm joined today by Jorge León from Madrid, Rystad Energy's head of geopolitical analysis. Jorge, welcome to the program.
Thank you for having me, Noah. It's always a pleasure.
Well, let's talk energy. Jorge, you've been extremely busy. Media requests, client briefings, market reactions, talking really nonstop about this Venezuela situation, and a situation, as I said, that's rapidly evolving. But what angle in this story do you think maybe isn't getting enough attention, despite all of the discussion? What's maybe not being talked about that you think is important?
Venezuela is moving from a world where exports were primarily flowing to China, and now it looks like it is going to Venezuelan crude barrels are going to flow to the United States, and that shift will require a lot of trade flows, reshuffles, new relations in the oil market, and I think that how that is going to be how that is going to play out will be crucial to understand the full scale of the situation. And the second important element that it has not received enough attention, and I think is crucial, is the fact that I don't think political stability in Venezuela is guaranteed. And let me explain you why. The Venezuelan constitution is very clear about what happened when a president is absent. The rule says that the vice president will take over, and that has happened. Delcy Rodriguez now is the former vice president, is now the president. But the constitution is very clear that there needs to be a general election soon. And there is this legal dispute right now because the constitution says that if the absence is permanent, elections should take place in 30 days. If the absence is temporary, still should take place in 180 days. So I don't know in which world we are, but it doesn't really matter. What my message here is that one way or another, we're heading towards a general election in Venezuela. And we know that general elections, particularly in the current environment, could be very destabilizing for the country. That's where civil unrest could happen, internal splits, the risk of coups could take place. So I guess I'm particularly worried about that part of the market situation in Venezuela.
It certainly is attracting an immense amount of attention from markets and from policymakers. So, why is Venezuela so important to global oil markets, despite that relatively low production level compared to Saudi Arabia or the U.S. or something?
I think it's for three specific reasons. The first one, I think, is the size of the price, if you want. Venezuela holds the largest oil reserves in the world, 303 billion barrels on its ground. But with a caveat, with a little asterisk there, it's true that these are a lot of barrels, but when we look at the type of crude and the economically recoverable resource is less than that, it's just 27 billion barrels. That is that Venezuela could economically produce. But still, this is massive. So the size of the prize, let's say, is really, really big, and it's much bigger than its share in current oil production. That's one element. The second element is the type of crude it produces. So the type of price, if you want. Venezuela produces a very specific type of crude, which is heavy sour crude. And this is particularly valuable for the U.S. refining system. That, let's not forget, is the biggest in the world. So that's the second reason. And I think the third reason is a little bit more geopolitical, if you want. Venezuela has a massive weight, geopolitical weight in the oil markets. It is a founding member of OPEC and is very active in the OPEC and OPEC Plus organization, even though they don't have a production quota right now. And also, Venezuela, or at least before the event, was part of the alliance with Russia, Iran, and China. So that lifts a lot of the weight of Venezuela in the global oil market.
What is it about Venezuelan barrels that make them in demand?
Venezuela produce most of Venezuelan production is heavy crude. And the way I like to think about this is that heavy crude has its pros and cons. It's sort of like dark chocolate of oil markets. Some people cannot handle it, but the people that can handle really love it. Let me start with the downside of heavy crude. Um, Heavy crude is harder in every sense. Let's put it this way: it is more costly. It is more energy intense to extract. It requires more energy, as I said. It is more difficult to refine. Just to extract the crude and transport it, you need diluent because it's a very sort of heavy stuff. That makes it a little bit less competitive. Let's say normally the price comes with a discount. So that's the negative side, but also it has very important upside potential, or the plus side. First of all, we shouldn't forget that the U.S. Gulf Coast refining system is configured mainly to process that type of crude, and this is a historical element here. When the U.S. refining system, the biggest in the world, was built, was in the 80s, 90s, 2000s. That was before the shale revolution, and back then most of the heavy crude production was coming from neighboring countries such as Canada, Mexico, Colombia, Ecuador, and Venezuela back then. So when the U.S. was designing its refining system, it really made sense to try to configure the refineries based on the crudes that were available. And back then, it was heavy crude. Then came the shale revolution. The shale revolution produces light crude, which is not perfectly substitutable for the heavy crude. So in a sense, from the point of view of the demand of that crude, there is this big source of demand that is the U.S. Gulf Coast. On the supply side, I think that the heavy crude bench is getting a little bit tighter. Yes, we have a lot of growth from Canadian supply in recent years and also in the future, but that part of that growth is probably going to start flowing even more to Asian markets as infrastructure now is available. And then you have other countries such as Mexico, Colombia, Ecuador, where production has been declining, and we expected production to keep declining in the years to come. So, in that sense, Venezuelan heavy crude oil is really valuable right now and in the years to come for the U.S. refining system.
We're talking about something that's often referred to as almost like tar-like or asphalt-like. And you had mentioned diluent, so this is a lighter hydrocarbon, like a light crude or a condensate that's mixed with it, and so it's able to flow, or it's heated. So it's really difficult. It's not like you just put a well in the ground and are able to just flow it through a pipeline. And so, it makes it difficult. And we're going to talk more about that upstream angle and Venezuela's production here in just a second. You know, I guess the key question for a lot of people is, can Venezuela quickly ramp up production? It used to produce as much as 3 million barrels a day. And certainly the oil industry has been in a very well publicized decline here, down to about 1 million barrels per day due to issues with corruption and maintenance and just general, I guess, what could be termed as mismanagement. And so I know we've done a lot of work on this question. I mean, what are the technical, the operational, the financial constraints to Venezuela actually tapping into the world's largest oil reserves?
There's a lot of potential, but this is not going to be fast This is not going to be easy, and this is not going to be cheap. So let me talk about the constraints that right now the Venezuelan petroleum industry needs to overcome to start showing growth. First of all, there's a chronic underinvestment in infrastructure, things like the pipelines, ports, upgraders, refineries, and so on, and in a very weak state. Partly done also because of the corruption and the macroeconomic situation in the country. So that really needs to be solved immediately as soon as possible. That's priority number one. And that will require money, but of course, time as well. The second important constraint that the Venezuelan industry has right now is a massive brain drain. Bear in mind that PDVSA and the industry in general has been managed by the army in Venezuela, and that coincides with a lot of very capable petroleum engineers and experts in the industry that left the country in Venezuela. So that's a massive problem as well. The third important constraint, I think, is Venezuela really needs to make sure that the political situation on the ground is stable enough to bring to incentivize international companies to start investing in the country. And as I mentioned, this is not assured, this is not guaranteed. There might be an election sometime soon. We don't know where the opposition stands right now. I think that probably the market is over assuming that the political stability is guaranteed. So I think that convincing international companies from that point of view is gonna be tricky. And then when we look at what needs to happen in terms of money, first of all, we are in a world where 2026 is going to be an oversupply market, probably 2027 as well. So we're likely to see decreasing oil prices in the next couple of years. Why is this relevant? It's relevant because in a world, in an environment of lower oil prices, oil companies tend to be extremely cautious where they put their money. And I think that in this case, they're also going to be extremely careful. And that's what the reading that we saw after President Trump's meeting with the CEOs of the oil industry. So those are the hurdles that need to be overcome in the next few years in order for the Venezuelan ec- um, sector to start producing and ramp up production. And in terms of money, we don't think that this is going to be fast. If it happens, and again, this is a big if, I think that the production in Venezuela could increase to 2 million barrels per day by early 2030 and to 3 million barrels per day by 2040. And this will require a massive $183 billion in investment. This is a massive amount of money that needs to be poured into the country.
How are we thinking about the if Venezuelan production were to increase? Let's say we're able, to see the investments go in, we're able to see the stability, we're able to see the infrastructure become upgraded, become more capable. How would that affect global oil markets? And how are we thinking about the return of Venezuelan production, perhaps?
It depends on the time frame. In the short to medium term, we don't think that Venezuelan production has a lot of upside potential. We're talking about in the next 6 to 18 months, no more than 200, 300,000 barrels per day at most. So the potential is very, very, very limited. So I don't think that this is dramatically going to move the needle in the short and medium term. Don't forget that 2026 is a world where we are facing an oversupply market, more than 3 million barrels per day of oversupply. The fact that Venezuela might produce 300,000 barrels more, it doesn't really matter that much, let's say, in the grand scheme of things. So the short answer is in the short term, very, very little impact. In the long term, things can be a little bit different. Again, with all the ifs and buts that I mentioned, let's assume that Venezuela manages to increase production. Let's say 2035, we're at 2.5 million barrels per day. Then that could have a bit of a bearish impact on oil prices. Let's say by 2040 they reach 3 million barrels per day. In our house view, we think that global oil supply by 2040 will be close to 90 million barrels per day. So 3 million barrels per day start to have sort of a higher impact, let's say, on oil markets if Venezuela can ramp up production. So I think that in the long term, if Venezuela can rapidly increase production, as we mentioned, it's probably going to be marginally bearish for oil prices. But when you look at the big, at the big scheme of things, this doesn't really matter, let's say, massively for oil, for the global oil markets, for the supply and demand fundamentals.
I want to shift over and talk a little bit about geopolitics because there's a major geopolitical component to this, to what's happening there. I mean, China. China used to be the major buyer of Venezuelan crude. It's no longer receiving those barrels due to essentially a U.S. kind of embargo of Venezuelan exports. I mean, the U.S. has been actively seizing tankers that it says are part of the dark fleet. Um, how has this shift impacted oil markets and flows?
But we think that the blow to China is actually fairly limited, and I'll explain you why. First of all, Venezuela only accounted for less than 5% of Chinese crude imports. So, in volumetric terms, it was marginal, let's say. Even though for Venezuela, China accounted for 70% of its destinations, for China, it was less than 5%. So, in volumetric terms, there's not a lot of loss, let's say, from China's point of view. The second important element is that right now there's a lot of barrels, sanctioned barrels in the world, from Iran, from Russia, that China could tap into and continue receiving those barrels. And again, this is an oversupply market this year. There's no deficit of barrels around the world. So from the energy security point of view, let's say, this is not a big blow for China. And final important element here is that let's not forget that 2025 was the year where China rapidly accumulated crude stocks, and probably with a good prediction of how the world might become more volatile, and energy security is and will be an important consideration for the Chinese administration. So those three elements will tell me that the blow to China is less than probably what people might think. And there's a final also element there to take into account, which is the geopolitical element, I guess. Um, the fact that China no longer has access to Venezuelan crude, apart from the, let's say, buyer and seller relationship that China and Venezuela had, I think the relationship was more finance, budget, leverage, sort of relationship between China. Right now, we know that there's outstanding Chinese debt on Venezuela, close to $10 billion. So we're not sure what is going to happen with that debt, and just losing the influence, the Chinese influence in Venezuela. I think that is more of an important blow for China.
What does the Venezuela situation mean for OPEC and OPEC Plus? And then I want to talk about potentially Venezuela's membership, after that. But kind of near term, what does it mean for OPEC and OPEC Plus and production policy?
Venezuela has a lot of geopolitical weight inside the organization. As I mentioned, founding member, very active in all the different committees and so on. But its weight is much bigger, let's say, than its actual production. Right now, OPEC Plus produces around 42 million barrels per day, and Venezuela produces just 1 million barrels per day. So if Venezuela leaves tomorrow, OPEC Plus, it wouldn't really affect the power that OPEC Plus has to control and manage the market and control and manage the production. So I don't think that this will be a major blow from the, let's say, operational point of view. It will be a blow from the geopolitical point of view because, as I said, Venezuela has a big say inside the organization and founding member. Now, if Venezuela leaves OPEC or not, I think the President Trump just a few days ago mentioned that Venezuela could stay inside the organization. So that brushed out some of the doubts. But I think it's also important to mention that let's assume, as I mentioned, that if Venezuela manages to start increasing production in the years to come, I don't think that Venezuela will be faced with a production target yet. Right now, Venezuela doesn't have a production target, but let's assume that production keeps increasing. I don't think that they will receive a binding production target anytime soon. And the best example is Libya. Libya has been excluded from production targets because of the past disruptions that they had. They are back to their pre-Gaddafi levels of production for almost a year and a half, and still they don't have a target. So my sense is that once a country is put into the bucket of exempted countries, it's very difficult to bring them out of that bucket. So I don't think that this will be an issue, let's say, in the medium term. But this raises a very strategic question, which I think is equally important. If the Venezuelan industry is run and controlled by international companies, then the question is whether it would make sense for Venezuela to remain part of OPEC Plus. And let me give you a perfect example here. OPEC Plus is a very diverse group of countries, but they have a very common feature. Most of the production is controlled by the national oil company. In Saudi Arabia, it's 100% with Aramco. In the UAE, close to 100% with ADNOC. And overall, the average for OPEC Plus is around 70%. So 70% of production is controlled by the national oil company. So that means that if tomorrow there's a production cut decided by OPEC, the minister will immediately just inform the national oil companies, and the cut will be affected, or the increase in production. So if tomorrow the Venezuelan industry is controlled by U.S. companies, if there's a possibility that there's a production cut, now how is Venezuela going to implement those production cuts into on international oil companies? That creates a problem. And we have a very interesting historical example, which is Kazakhstan. Kazakhstan is the only country, one of the only few countries where the share of production owned by the national oil company is very low. It's close to 30% only. And guess what? The country that has failed significantly in the last 3, 4, 5 years to comply with production cuts has been Kazakhstan, because it's very difficult for a country to impose on international companies to implement cuts. So that element, that strategic element, I think is really, really interesting, and we'll see how things might evolve in the future. But that raises a question of what is the advantage, the benefit from Venezuela to be part of OPEC if the industry is run by international oil companies.
We've had a lot of geopolitical news over the past week, and who knows where it all could be going. But I mean, some other geopolitical flashpoints. We've mentioned Iran. Talk to us a little bit about how you see the Iran situation quickly here, and maybe how both Iran and Venezuela, or how this kind of general geopolitical pressure on the market might play out.
This has been a rocky start of the year. First Venezuela, and then we moved to Iran, and how things have evolved. Start of nationwide protests, starting from 28th of December, and then rapidly spreading across the country. Many demonstrations. Our numbers show that there's been even more demonstrations than back in 2022, when the latest waves of demonstrations. So there's increasing internal unrest in the country, and at the same time, there's increasing external pressure on the country, particularly from the U.S. Just imposing 25% tariffs on countries that are doing business with Iran. So growing pressure. We know that President Trump has been briefed about possible options, military options in the country, and that was reflected in oil price. Oil price just a couple of days ago increased to $66 per barrel, the highest since October 2025. So this really increases geopolitical risk in the oil market, and it matters because, as opposed to Venezuela, Iran produces 3.2 million barrels per day, so it's more than 3 times with the size of the Venezuelan production. And it also matters where Iran lands in the world, is in the Middle East, has sort of access to the Strait of Hormuz. It's surrounded by very important oil producing countries, so that's why the market impact of a potential disruption there could be much bigger. Let's say, and there's three important elements or comments that I would like to add on those. Let's not forget that there's historical parallels here that are worth taking into account. The 1979 Islamic Revolution also started with a wave of protests on the cost of living and macroeconomic situation and economic well-being of people. And we know how the story ended up. But in terms of production, Iran lost 2.4 million barrels per day of production in 1979 because of the protest strikes and social unrest. So, and back then, of course, the market was much smaller. So in percentage terms, 2.4% million barrels per day was massive. And that was what provoked, let's say, the second oil crisis in 1979. So that historical parallel should be taken into account and keep on the back of our minds, I guess. The second comment, I think, is I want to go back to June 2025 when we had the 12-day war and we knew what happened. Well, but one of the key takeaways for me is to talk about the closure of the Strait of Hormuz. The threat of closing the Strait of Hormuz is always on the cards for Iran. And I think that my key takeaway from those 12 days was that closing the Strait of Hormuz was probably overstated in the market. Probably the threat is less than what we really thought. Let's say. First of all, from the operational point of view, I think Iran could close the strait for a couple of days, 3 or 4 days, but I don't think they can handle closing the Strait of Hormuz for an extended period of time. The immediate reaction of the U.S., the immediate reaction of regional powers such as Saudi Arabia, the UAE, would not allow for that. There's also the element of oil revenues are massively important for the regime, for the Iranian regime. So closing the Strait of Hormuz would not be in their best interest. And then the final element is China. China is the main buyer of Iranian oil and also Qatari gas, LNG. So the closure of the Strait of Hormuz will affect them massively. And as we know, China is a main ally of Iran. So in that sense, I think that threat was probably overstated, and that's a key learning that probably we need to take into account in case things escalate further. And the third comment, which I think is important also, is the impact that forced regime changes could have in a country. And the Middle East gives us a lot of historical examples that are worth taking into account. You see Iraq after 2003, Libya after 2011, and Yemen after 2011. After a forced regime change, those countries went into massive unrest, civil wars, and a lot of volatility and instability. So I'm cautious about thinking that a regime change could solve the situation. It could actually lead into sustained volatility and uncertainty and unrest for years to come.
Venezuela and Iran face, certainly some similar threats from an oil market perspective when it comes to stability, when it comes to the availability of flows from them. But Iran just on a much larger scale, bigger producer in a more kind of pivotal point in the world. And that's maybe why we see the differentiated impact in market pricing from the Venezuela situation and the Iran situation. Is that the right way to think about that?
When you look at price reaction after January the 4th, prices barely moved. The news was giving us very little price volatility. There was a little bit of a spike in oil prices, couple of dollars, the initial trading day, but then things sort of stabilized around $60 per barrel, very similar to the level that we had before the Venezuelan events. As the growing protest in Iran accumulated and the U.S. started thinking about military options, we saw oil prices rapidly increasing from, again, $60 per barrel into $66 per barrel. So I think that shows the importance that each of those two countries has right now in the global oil market and how risk premium is being priced in the market.
Well, Jorge, it's always a pleasure to have you on the program, and thank you so much for making time in your busy schedule to join us.
Thank you so much. No, it's been a pleasure.
Let's recap. Venezuela's near-term impact on oil prices will be limited, as the market had already discounted the reliability of its existing production, and it's comparatively a smaller oil producer than it was years ago. In the longer term, however, Venezuela's large oil reserves will require equally large investments to unlock, as well as legal and security backing from the U.S. The geopolitical ramifications of U.S. intervention in Venezuela are only just being felt, but it certainly complicates the strategies of both China and the OPEC Plus producers group. Thanks for listening to Let's Talk Energy. This podcast is a Rystad Energy production, produced by Laura Rodriguez-Skaug and Bada Og. Check out the show notes for further analysis on the topics that we've discussed in this episode, and connect with us on social media. We're at Rystad Energy on all your major platforms. While you're there, leave us a review, subscribe to the podcast, and hit that like button. You can also keep up to date on our website. If you'd like to send us questions, to reflect on today's show, or maybe you've got an idea for a future topic, go ahead and email us directly. It's podcast@rystadenergy.com. And most importantly, don't forget to join us next week for more Let's Talk Energy.